All right, welcome back. We've got a stock market update, and this was a big week this week. We had the Federal Reserve meeting, and the Fed decided to cut interest rates by 50 basis points. So this was the first time in a while that I've seen the market unsure of exactly what the Fed was going to do. It was kind of a toss-up, 25 basis points, 50 basis points. You could make a case for either one, and the market was very unsure going in. Typically, the market prices in what the Fed's going to do. So neither would have surprised me, but I was a little surprised by the 50 basis points. I think it would have been a safer play for them to go 25 basis points, but I do agree with their 50 basis points cut. I think they should have cut in the last meeting, so I think they're kind of making up for lost time. But it was pretty interesting to see how the market wasn't exactly sure what was to come. So this is the first 50 basis point cut since 2007. During the pandemic, when they were cutting rates, they did it in huge increments. It wasn't 50 basis points, 25 basis points. It was 1%, 2%. It was huge cuts, straight to zero, because of just the complete shutdown of the economy, something we've never seen. So it's going to be interesting to see what exactly the market does from here. We're in a very weird, tricky time in the market. So what does this mean? What does the 50 basis point cut mean? Well, in the reality, what we're seeing here is they've obviously been done raising rates for a while, and now we're in the easing cycle. They're going to bring rates back to a more normal stance. That's what the Fed kept saying. In their speech, they said the economy's growing at a good pace. We're seeing things doing well in the job market. We're seeing a lot of progress when it comes to inflation, and they want to get rates back to a normal policy, a normal stance. So let's look at the interest rate chart, because what they're saying here is we've had rates on the higher end. Oh boy. Sorry about that. Chart is freaking out. So we are looking at a weekly chart of the 30-year interest rate. And ever since I've been alive, come on, don't do this chart. Ever since I've been alive, rates have been going down and down and down and down. Now we reached zero basically during the pandemic, where they just suddenly just collapsed rates to stimulate the economy. Then we had inflation. The economy opened back up, and they needed to slow down inflation, so we had a rapid increase of interest rates. They're saying they want to get back to a normal policy. This is not normal. This just constantly going down and down and down. I don't think this is great. It's great for asset prices to go up, but you get a lot of bubbles. You get things like 2008. You get the dot-com bubble. So I hope that they settle out in a more normal stance around 3%. We'll see what happens. If they're back down to 0%, the next time we have a real crisis, there's nowhere for them to cut to stimulate the economy. So it's good for them to have a cushion, and we're in a good spot here for if we really see a slowdown in the economy, boom, they cut rates, and then that'll help ease the pain in the economy. If we're already at zero, there's no room to cut. So that's the good news here is if we do see a slowdown, the Federal Reserve can step in and help stimulate the market. So I've got a lot of feelings about the Fed, but that is the best thing about the Federal Reserve is they can really help avoid a Great Depression, multiple bank runs and things like that. Now, are their hands probably too much in the market, and we constantly see these ups and downs in interest rates versus the market dictating a natural interest rate? I would say yes, but there's pros and cons. The pro is we're not going to see huge, long, deep recessions, depressions that last for 10 years and just really wreck people's wealth. The con is we're creating the haves and the have-nots. So you're either on the train with assets that's going up, or you're on the train with no assets that is getting inflated away, and your dollar is being stretched and not worth anything every 5 to 10 years. So that's all I'll say with the Federal Reserve. the question again is going to be, what is the new normal? Because obviously we see a change in the trend here. We're no longer just going straight back down. I don't anticipate us to just go right back down in this trend. I would expect us to come down, kind of settle out, have a recession, and then inflation, and kind of be bobbing around from 2 to 6 is what I would expect interest rates to be doing over the next decade, hopefully. Hopefully we get back to some normalcy when it comes to interest rates versus just constantly going back down. So the surprising part of the 50 basis point interest rate cut is that the Fed, without saying it, is seeing some softness in the economy. They're worried about the economy going to the downside, jobs market really getting soft versus inflation ripping back up. If they were really worried about the economy just ripping and inflation ripping, they would have done 25 basis points. But the fact that they did 50 basis points is telling the market without verbally saying it, because they can't come out in their meeting and say, we're worried about the economy, that's why we're cutting 50 basis points. If they did that, you'd see the stock market collapse. And then they would create a recession without, they would put an onset of a recession. So they can't come out and say that. They have to come out and say, economy's strong, economy's great, everything's good. But we're cutting by 50 basis points. We're loosening monetary policy more in a more aggressive stance. So that's my little update of what the Federal Reserve did this week. Now let's look at how the market reacted to the cut, because we are at all-time highs in the S&P 500. Look at that. We've had that red line there for a long time. We're looking at the weekly chart. Let's go ahead and zoom in on the daily chart. And we're peeking our head above this red line that we've been here for a while, looking at that target for a long time. So congratulations, everybody. All-time high in the S&P. And we close at an all-time high on the Dow Jones. Looks like, almost. Well, these are the futures. Futures are going to be a little different than the cash settled product. And let's go ahead and look at the NASDAQ. NASDAQ is getting back up to testing those highs. So we're getting pretty close here to poking our head above the all-time highs here also on the NASDAQ. Let's take a look. How far do we have to go? 4.5% until we breach that all-time high. So it's a good week in the market. We see a nice rebound from these lows that we've had. Again, the uptrend looks really good. But when we're trading near all-time highs, we've talked about it, a lot of warning signs. So I'm not aggressive at adding a ton to my positions here. I am looking to start to sell some covered calls next week if we get some more green days. I did sell a covered call yesterday on Tesla. Other than that, I'm not hedged at all. So we'll have to wait and see what happens. Crude oil had a nice bounce. I am hearing a lot of talk about how much the U.S. is producing when it comes to oil. The U.S. is now producing more oil than Saudi Arabia. So our oil production is at an all-time high, which is very interesting, because you wouldn't think with this administration that they would have that stance when it comes to oil production. So you should see the price of gasoline continue to come down, and that's going to really help inflation. I wish they were doing this during 2021 when we were just getting killed with inflation and oil was ripping. We were not producing the amount that we were. That's when they turned on the machines to start producing. So there's a big lag effect, and now we're seeing all this supply hit the market, and that is causing the price of oil to come down, which is going to be good for the consumer, and that'll continue to be a nice headwind for us. We're seeing Bitcoin and some risk assets continue to push up. Let's see here. Nvidia not doing much, but what was the stock? Apple. Apple's doing great. Apple's at 130. So looks interesting here. And let's go ahead and take a look at the heat map. Because when we look at the weekly performance, we should see kind of green across the board. So you're seeing some of the beat up technology names. Wow, I didn't know Meta was up 7%. So you're seeing energy get a bid. Oil had a nice rebound this week from the lows. Insurance, banks had a rebound. So some of the things that have been beaten up the last couple of weeks, getting some money coming back in. And those defensive sectors selling off a little bit. Nvidia still down this week, but you've got Google and Meta, the biggest, brightest green I see on the screen here. Some of the industrials doing well also, but a lot of the financials down here. The banks, you can't really see it's being cut off, but some of the asset management companies having a nice rebound. Interest rate sensitive, so interesting there. So there was probably a sell-off, and then they got bought up on the interest rate move, because we did see a big pop in the markets the day after the Fed raised rates. So there was just volatility, and the market was flat on Wednesday when they raised rates. But yesterday, Thursday, was a big green candle in the markets. Seemed like everything was just really moving well. I think Tesla was up 7%. So again, it's a tricky scenario, because interest rates does stimulate, lower interest rates does stimulate the market, but think about it. They're at the beginning of the rate cut cycle. If I wanted to go buy solar, if I wanted to go buy a car, if I wanted to go buy a house, they just started lowering rates. They're going to keep lowering the interest rate. Do you buy the first rate cut, or do you wait for them to cut 3, 4, 5 times and then you go out and make your purchase? That's the question to me. Is I heard someone talk about the first rate cut is actually it's not as stimulative as people think, because the consumer is going to wait for a few more rate cuts to come before they go make those big purchases, because we're at the peak of the roller coaster when it comes to interest rates. We just started ticking down. You want to buy things when rates are lower. You want to finance things when rates are lower. And it's going to be very interesting what this does to the housing market, because there's a lot of people that are wanting to buy a house. These mortgage rates are just killing people. Do I have mortgage rates on here? I do. Where are the mortgage rates? So they're coming down, 6%, 30-year fixed mortgage rate. So again, do you go buy a house here, or do you wait until we're back 5.5, down in the 5s, under 5? I don't know. So I'm very interested what housing is going to do. I could see this doing either scenario. I could see this unlocking a lot of supply. A lot of people have been waiting to move. They have a 2% mortgage. They don't want to give that up for a 6% mortgage. Now that it's 5.5, maybe that's enough for them to say, you know what, I'm going to sell this house that has a 2% mortgage that has increased $300,000, and I'm going to move out of state that I've been wanting to move to, and I can tolerate a 5.5% mortgage or a 5% mortgage. So that could bring on a lot of supply to the market, and if a lot of supply comes on the housing market, you should see prices come down. I could also see a lot of people that have been waiting for interest rates to come down to make a purchase come in, and that could buy up the supply. So I have no clue what this is going to do for the real estate market. I don't think anybody does, but it's going to be interesting to see what happens here. So I can go on and on, sector by sector. Tesla, same thing. Are you going to see a sudden spur of demand when it comes to people wanting to buy cars? Tesla's been stimulating, or what should I say? They've been subsidizing their interest rate with 1% and even 0% interest on their cars. Does that continue? Are people going to say, you know what, I'll take the 4.5% that's available now on the auto loans? Or are they going to keep waiting? Is Tesla going to have to keep subsidizing those interest rates? What does that look like for demand? So we're at the very beginning stage of the rate cuts. It's a good thing for the economy long term. The question is going to be how much pain until we really see these rate cuts working its way into the market, because we've had these higher interest rates for a while now, and there's a lag effect for that as well. So we're just kind of at a tricky spot here. So we're just going to have to take it week by week, month by month, and see how the numbers do, how the earnings are continuing to develop, how the new home sales are going, and how the real estate market's doing in general. So last thing I want to talk about here is gold. Gold is just ripping. It's pretty unbelievable to see. And then let's go ahead and look at, there wasn't a whole lot of other numbers here this week. We had a unemployment number came in better than expected, probably to be revised to the downside down the road, as all the other numbers have been. Coming up next week, we've got a GDP number for this quarter, and then we've just got a lot of Fed speak. Jerome Powell will talk. A lot of other Fed members will be yapping. Other than that, we've got an inflation number, PCE number coming in on Friday, and then the following week, I believe, is going to be the jobs numbers. So we've got non-farm payroll October 4th. So not a whole lot coming up these next couple of weeks. We are going to get back into earnings pretty soon here, so that'll be something to look at as well. I know FedEx came out with their numbers, and their numbers did not look good. We saw some restaurant companies this week, really bad numbers, bad guidance. So again, who knows? We're just at a very tricky spot. And we're going to end here with this chart right here. So the S&P 500 1 year after the first rate cut. So we have March 2020. Obviously, the stock market was killed, so it's going to bounce from the destruction that we had. 2019, we were up 9% 1 year later. 2008, we were up 8%. 2007, we were down 20%. 2002, we were up. 2001, we were down. So the odds look good for 1 year from now that we are going to be higher than where we are, but there's a possibility we're at the top of the roller coaster. The economy will come down. We'll go through a bad year next year, and then we come out of that. I don't know. Who knows? I'll tell you when it's done. But that is all I got for this. This is a very macro-driven stock market update. So I will talk to you guys next week. Have a great weekend. Enjoy the warm weather while we got it. And go Seahawks. Peace out.